Welcome to the first part of Module 3, which dives deeply into the fascinating world of technical indicators. This segment focuses on powerful analytical tools like moving averages, RSI, MACD, and Bollinger Bands. These indicators are absolutely essential for analyzing stock prices, understanding market psychology, and making highly informed trading decisions on any charting platform. To apply these analytical tools, a trader must first open a charting platform or a dedicated stock screener website. By navigating to the built-in Indicators menu, one can easily search for and select specific mathematical tools to overlay directly onto the price chart, instantly transforming raw market data into actionable visual insights. The first major tool to explore is the MACD, which stands for Moving Average Convergence Divergence. It is a highly popular technical indicator specifically designed to help traders understand the underlying direction and shifting momentum of a trend, ultimately assisting in generating highly probable potential buy and sell signals in the market. Looking closely at the precise MACD settings, it typically consists of a 12-day exponential moving average paired with a 26-day exponential moving average. The constant interaction and crossing between these two specific moving lines is exactly what creates the core signals that professional traders monitor for strategic market entries and exits. A clear buy signal is generated when the faster 12-day EMA, which is often colored blue on charts, crosses directly above the slower 26-day EMA. This upward crossover indicates strong bullish momentum. Conversely, when the blue line crosses below the orange line, a red histogram appears, signaling a potential sell opportunity to the trader. The histogram bars play a crucial role in visually representing trend strength. For instance, if the bars turn light green and start shrinking while the price is still rising, it indicates that the upward momentum is weakening. However, traders must note that this loss of strength is not an immediate sell signal on its own. When trading with MACD, initial price targets are often set at established resistance levels on the chart. Because many market participants use this exact indicator simultaneously, it creates a powerful psychological effect. If everyone sees the same buy signal, their collective buying action can actually drive the asset's price upward. Moving on to the Relative Strength Index, commonly known as RSI. This momentum indicator features major horizontal threshold lines, typically set at 70 and 30. When the RSI line crosses above the 70 mark, the asset is considered overbought, suggesting the price has risen too fast and a downward pullback might occur soon. On the flip side, if the RSI drops below the 30 level, the asset enters oversold territory. This indicates that the price has fallen significantly and perhaps too quickly. In this scenario, buyers might soon step in, presenting a potential opportunity for the price to reverse its trend and head back up. A more advanced use of this tool involves spotting RSI divergence. This specific phenomenon occurs when the stock price is steadily rising to new highs, but the RSI line is actually falling. This glaring divergence is a strong warning sign that the upward price trend is losing underlying power and might soon reverse downward. Next up is the Bollinger Bands indicator, which consists of 3 distinct lines: an upper band, a middle band, and a lower band. These bands dynamically adjust to market volatility in real time and provide excellent dynamic support and resistance levels directly overlaid on the main price chart. The lower band frequently acts as a reliable support level, indicating a potential upward reversal when the price touches it. As the price bounces up from the bottom, the middle band often acts as the first line of resistance. If the price successfully breaks through that middle layer, the upper band becomes the next logical target. One of the most powerful and sought-after patterns is the Bollinger Band squeeze. When the 3 bands contract tightly and get extremely close together, it indicates a period of very low volatility. This tight compression often precedes a massive price movement, meaning a strong directional breakout could be right around the corner. Another vital tool in the technical arsenal is the Exponential Moving Average, or EMA. Traders often overlay multiple EMAs on a daily time frame to accurately gauge trends. A common and effective setup involves using a short-term 6-period EMA in green, a 15-period EMA in red, and a 50-period EMA in blue. A buy signal naturally occurs when the fast 6 EMA crosses above the slower EMAs. However, relying solely on the 6 and 15 EMAs can create excessive market noise, leading to false signals. To filter this out, experienced traders use these crossovers in conjunction with established support levels and distinct candlestick patterns. For a much broader long-term perspective, the 200 EMA is incredibly effective. As long as the asset's price remains above this major moving average, it confirms a strong long-term uptrend. When the price occasionally dips to touch the 200 EMA, it often presents one of the absolute best long-term buying opportunities. It is absolutely crucial to remember that indicators should never be used in isolation for making buying or selling decisions. They are strictly confirmation tools. A robust and reliable trading strategy combines raw price action with multiple indicators like RSI, MACD, and Bollinger Bands to thoroughly validate whether a price is truly likely to rise or fall. By mastering these core technical indicators, traders build an incredibly solid foundation for analyzing market momentum and overall trend direction. With these essential tools firmly established on the chart, the next logical step involves measuring the precise step of market pullbacks using advanced mathematical ratios. Diving right into the foundation of these tools, the Fibonacci sequence was discovered by a mathematician whose name the tool bears. The sequence starts with 0 and 1, and each subsequent number is the sum of the previous two. From this mathematical sequence, we derive key trading ratios, such as 23.6%, 38.2%, 50%, and 61.8%. Interestingly, these exact mathematical ratios appear everywhere in the natural world. If you look closely at the spiral of a flower, the structure of animal shells, the shape of the human ear, or even the vast formation of galaxies, these proportions are consistently present. Traders realize that human psychology and market movements also naturally adhere to these universal mathematical constants. Applying the Fibonacci retracement tool to a trading chart is straightforward. On most charting platforms, you simply open your screener, navigate to the drawing tools on the side, and select the Fibonacci retracement option. This powerful tool serves two primary purposes for analysts: identifying potential support zones after a price swing and projecting future target levels following a breakout. Let us examine the pullback strategy during an uptrend. An uptrend is characterized by the market consistently forming higher highs and higher lows. When a stock rises to a new higher high and then begins to fall, traders use the retracement tool to anticipate exactly where the next higher low might form before the trend continues. To project these support levels, the tool is drawn by connecting the recent swing low directly to the new swing high. To make the chart easier to read, traders often clean up the tool settings. By unchecking the trend line, background colors, and minor levels, the chart becomes much less cluttered, allowing the essential support zones to remain clearly visible. The most critical area on the retracement tool is known as the golden zone, which consists of the 0.5 and 0.618 levels. This is a high probability demand zone where buyers frequently step back into the market. When the price falls into this pocket, there is a strong statistical likelihood that the downward correction will reverse. However, simply touching the golden zone is not an automatic buy signal. A proper entry plan requires waiting for a clear reversal candlestick pattern or a strong volume breakout above immediate resistance. To protect capital, traders typically place a stop-loss order just below the previous swing low, or strictly below the 0.618 level, acknowledging that no strategy is flawless. Sometimes the price will slice right through the golden zone and drop to the deeper 0.786 level. If there are no reversal signals, traders might look for a bounce here, but it carries more risk. Conversely, bouncing off minor levels like 23.6% often indicates market manipulation, and taking trades at those shallow pullbacks can trap buyers. Once a stock breaks out past its previous high, traders switch to the Fibonacci extension tool to find upcoming resistance and target levels. While the retracement tool finds support, the extension tool projects how far a new rally might go. To draw this, the process is reversed. The analyst drags the tool from the recent swing high down to the swing low. By enabling extension levels like 1.414 and 2.414 in the settings, the tool plots invisible ceilings above the current price. If a stock breaks its equal highs, these extension lines serve as the next logical resistance zones. Traders use these exact projections to take profits, knowing that the price will likely consolidate upon hitting these targets. To wrap things up, remember that the Fibonacci retracement tool is your primary guide for finding support zones and planning safe entries during market pullbacks. Meanwhile, the Fibonacci extension tool is essential for mapping out future resistance levels and setting realistic profit targets after a breakout. Mastering both tools allows traders to navigate market swings with mathematical precision.